Hey everyone, welcome back to the Money Level Show where we think, act, and prosper. And today I have a special guest with me. We talk a lot about fundamentals. We talk a lot about macro factors and how this affects the economy, how it affects our pocketbooks and things like that. But today, the guest I have is going to get more into the technicals and look at some charts and things like that. So I want to welcome Gareth Soloway, who is with In the Money Stocks. And so you may have seen him a few times on Kitco News and some other platforms. So Gareth, I want to thank you for coming on today.
Hey, thank you so much for having me today. It's great to be here.
Yeah, for sure. So on my show, I named it the Money Level Show because people come into this world of investing at all different types of levels, whether that's you've never saved a dime in your life, whether it's you want to start investing, whether you've been doing it for a while, have a retirement fund, don't have a retirement fund, traditional funds and things like that. So people just come in at different levels, and some people work 9 to 5 jobs, some people are full-time investors, and so I like to bring diversity and variety to this space, because people want to learn more about these things. Like even for me, I want to be eventually be a trader or something. Like I don't want to go to a 9 to 5. I talk about my 9 to 5 sometimes, and I'm like, I love what I do. I work with kids. I do juvenile probation, but it's not, I'm not gonna build the most wealth for me and my family that way. And then also, it's one of those things where I want to have flexibility with my schedule. And so share a little bit about your background and your career as a trader. Like what led you to that?
So I come from relatively humble beginnings. Both my parents were teachers. They never invested really at all. I never had exposure to investing. I don't come from a Fortune 500 family or anything like that. In high school, I got exposed to kind of the investment club thing where we had to just pick stocks and you'd hope that it would do great and you'd be in the top of your class or whatever. And it just happened to be in kind of that mid to late 90s period when these dot coms were going nuts. And I remember I had like 100,000 fake money, right? And it was all fake money back then. And the gains were so astronomical, kind of like the meme stocks right now, where you'd see a stock going up 100% a day, a couple days in a row. And even though it was fake money, turning 100,000 into 150 and then to 200, it was addicting, right? So for someone who I think I got like $1 a week in allowance or something ridiculous. And I guess maybe back then it wasn't as ridiculous, but it was incredible money, even though it wasn't real. And it made me say, okay, I gotta look more into this. This is something that to me seems like a great potential career opportunity if I could do it as a career. So I went off to college. I got my economics degree, and I worked for MetLife for a year. Hated it. Nothing against MetLife. It was just a lot of cold calling. I thought that was kind of my inroads to financial planning. But really, the whole time I was working there, I was like sitting at my laptop trying to trade my small account, right? And back then, it was maybe $5,000 or something like that. So when you talk about people, your viewers that have are just starting out or don't have a lot of money, I've been there. And it's good to start small. Believe it or not, it's good to start with very little money because it's less money to lose. Now, it doesn't seem like that at the time. It's a gut punch, but every trader that starts is going to go through hardships in learning how to invest and trade properly. So basically, what I did was after college, after that 1 year at MetLife, I quit. I said I'm going to learn to do this on my own. I worked 3 different jobs to fund my trading account. I was able to get it to $10,000. I worked with a prop firm that gave me 5-to-1 leverage, and I would lose money, and then I'd have to work my butt off and just make it back and put it in. And I literally I remember days where I was like, okay, well, I could eat lunch or dinner today. What do I want to do? Because I don't want to spend the money to eat both. So I would just
Mhm.
do what I had to do and grind it out. And slowly and surely, things fell into place over time. So that's really the story there. But going back to what you were saying about your viewers, I find that so important. When you're a newer viewer, and this is one of the most common things I see in new investors, is that they come to me with 5,000 or 10,000. They say, okay, give me an options trade that's going to double or triple, right? And the essence is people like that, you're going to lose your money because options are very, very tough. you want to
Hmm.
look at it like a marathon, right? You're not in a sprint. You're not trying to go from a $10,000 account to $1 million overnight. You want to do it slowly. And what I always tell people to do is take a calculator and start with $10,000 and multiply it by just 25% a year and compound that. And what you'll see is that it doesn't take that many years to build that amount of money into something very, very big. And that's doing it a slow and steady way versus trying to gamble and hit a home run. So be careful starting out. I can tell you from experience, I lost a lot of money early on, and it was only through a lot of trial and error that I learned how to do it relatively correctly.
Yeah. That's very important. I remember last year, we had the big liquidity shock back in March. I just started getting into, like, I just bought some companies. I think I bought like Children's Place at like $9 or something, and a few other stocks. And me and my cousin, he was getting into options, and then eventually I started learning about like precious metals and like more about the economy and stuff, because the pandemic just shifted my thinking. Like, I had zero in my bank account when the pandemic started, and I was like, I gotta change this. Like, I can't, if I lose my job, I'm doomed. I mean, I could get unemployment, but I'm doomed. So, I really started changing my thinking. But it was a lot of like euphoria around a lot of the tech stocks, a lot of the electric vehicles, the vaccine companies, the medical stocks. Like, it was just crazy. And my cousin was making a lot of money. I wasn't making hardly anything, because I was more value investing, and learning about good companies that have good valuations and weren't overvalued and things like that. So then, so I kind of took that tortoise route, rather than the hare. And so then, coming into this year, when we saw a lot of the rotation into the more value stocks and commodities, I started seeing my portfolio doing well. And I was like, hey, I looked at my charts, like, my portfolio's been going up consistently, and I'm not really worried about it, because I'm not in anything that's overvalued. Especially when we saw the treasury yields rise, and then the tech stocks got killed back in February. So that's really important. Like, when you said that, because it was definitely something that I've been thinking about.
Yeah, and you want to make sure, there's a lot of hype around the meme stocks right now. And prior to that, it was Dogecoin, right? And you just kind of have to step back. Is that if you get in early on those, they're awesome. But again, you don't want to be, I never want to be a follower, right? You always want to be leaders in life. And that applies to my investing strategy as well. And I've missed millions of trades that could have made me millions of dollars. But it's all about the ones you do catch and being patient and just sitting back and saying, okay, listen, I'm not going to jump into AMC at $65. Instead, I'll wait for it to pull back to this level, because this is a level that to me makes sense. Just like with Dogecoin, I've never been an investor in Dogecoin, because my cryptocurrency thesis is that it's an alternative to the dollar and a way to get away from the Federal Reserve printing trillions of dollars, the
Hmm.
government debt. And Dogecoin, every minute, another 10,000 Dogecoins are printed. So that doesn't fit my thesis for why cryptocurrency is important to me personally. So I
Yeah.
don't do that. Now, I missed out on a ton of upside there, but I'm okay with that, because I have to be able to look myself in the mirror and say, okay, I did this investment based on this reasoning behind it.
Yeah, for sure, for sure. That's a good, valuable lesson. So how do you balance like fundamentals and technicals when it comes to trading? Because, like, obviously, I had a friend of mine. He was looking at the technicals of AMC. He was like, "Hey, AMC due for a breakout," and I was just like, "Okay, well, when we had the whole thing with Robinhood shut everything down, I thought it was dead. I thought the short squeeze was dead. And plus media and all that stuff, FUD and stuff. But and then it breaks out, and I'm just like, okay. So then I started researching the fundamentals and started seeing, like, okay, this is what's actually happening. And
Yeah.
that's kind of how my brain works. It's like, I don't just look at a chart and just be like, okay, it's gonna go this way because of this pattern. It's like, I need to know the fundamentals behind it too. So how do you balance that?
So the fundamentals are definitely important for a lot of the bigger stocks I trade, whether it's Apple or Amazon. Those ones I more follow the chart, because they will, they'll bounce off of key levels. When it comes to smaller stocks like AMC, the fundamentals are really important for me as an investor. And again, sometimes that means I'll miss crazy runs to the upside. Like for instance, right now I am short AMC. It's down a little bit today, but the thesis of the fundamentals is important. And I want to show my chart here. I think this will be valuable for people to kind of understand one of the reasons why I'm short AMC. Now, I don't have a big position. Anytime you go into a stock that can go up 100% a day, you never put a lot of money at risk. Basically, I go into it and I say, I believe that there's a 75% chance that I could make a good amount of money here, but I could also lose, and I have to be okay with that potential loss. But looking at the AMC chart here, check this out. If you go back to 2015 here, the stock was trading at around $35 a share, as well as right over here. And it's important to recognize in that time period, back in 2015 and 2016, there were only 100 million shares in the company. All right. Now, if you fast forward to today, there's over 500 million shares in the company. So that means that shareholders that bought back then have been diluted by 4 times, basically, right? So one share became 5 shares. The issue with that is that it actually, if you put it in terms of the valuation from when the movie industry was really good, so back in the 2015, 2016 levels, we didn't know about COVID. You didn't have a lot of the streaming services really powerful yet to bring people away from the movie theaters. But if you map it out, the current price at $50 on AMC has to be multiplied by 5 to put it in equal stature with the price point back in 2015. So at $50 in 2015 terms, AMC is actually $200, actually $250 a share. And that's something that I just can't get over, considering, like you said, you're a fundamental guy. You're thinking, okay, well, the movie theater business, I can just see it in front of me, is declining because people can go to, I was saying this the other day, is you can go to Costco and buy an 80-inch TV for your house for a couple $1,000. You can get a nice reclining chair, and you don't have to sit in a crowded theater where, I still remember this, and I'm sure you've had this experience, someone sneezes like right behind you, and you're like, oh, like, oh gosh, that's not fun. So for me, I think there'll always be a place for the movie industry, but it's going to shift more and more to the in-home experience. And that'll be why AMC is one of the reasons why it probably will never be majorly profitable again.
Yeah, that's really important. You said that. I was watching interview with Neil Howe. He wrote the book The Fourth Turning, and he does a lot of demography. And he was saying how everything is happening within the home, and this is gonna change future generations and how they operate, because right now everything is in the home. The TV's in the home, the movies are in the home. I watched Mortal Kombat and King Kong versus Godzilla, at home. So that is very important that you said that.
And also, like Disney is releasing movies straight to their streaming service, as are other streaming services now too. So, these movie theaters are going to have this competition where, the same day it's in the theaters, you can watch it on your 80-inch TV at home in that movie experience type situation. So you're really getting that edge of where AMC would have these movies for, let's say, 3 or 5 months ahead of time before anyone else can go watch them. Now they don't have that edge anymore on a lot of these movies.
Oh yeah. I didn't even think about that. That's important. So what's your current take on the market in regards to inflation, dollar devaluation? I had a conversation with my coworkers yesterday. I've been telling them about inflation for a while, and then they ended up just sharing like, hey, my subscription, my Amazon subscription went up, my storage unit went up. I told them, I was like, I have my real estate licensing fees went up. So we see that the dollar's losing value, and we see that inflation's happening. How's this impacting the market, and what's your take on that?
Yeah, so there's definitely inflation. You're seeing a huge amount of inflation recently because of, we've seen lumber prices, we've seen copper prices, all these input goods into things like homes and such are going through the roof. So you're going to see this continued inflation bug hit. The question is it transitory, which is what the Federal Reserve wants us to believe. I think, again, you're going to see, 5-6% inflation for multiple months here. And then I do think it's going to back off a little bit just because the bottlenecks are kind of moving away, or they're kind of freeing up. But I don't think that it's going to go back to that 2% level that the Fed wants it to. And that's why I'm concerned. I think, you have a situation where they're going to continue to have to devalue the dollar to pay down the massive amounts of debt that this country is accruing. And you have a scenario where, you look at COVID, and it kind of was a surprise recession. But just in terms of cycle analysis, the economy goes up and down, out of a cycle into a bull market and then into a recession. And at some point, we're going to have a recession again. And if the Fed can't get interest rates up enough going into that, just like going into COVID, they didn't have interest rates up enough, then they're going to have to figure out how to stimulate the economy again when we dip down, and that's going to be more money printing. I mean, they've basically to themselves proved that the money printing thesis works. I don't like that way, because every dollar you and I earn is less, worth less every single month that they're printing more and more money. So
It's
I,
almost
I
like AMC,
overall
like
am
how you.
nervous about that.
It's almost like how you mentioned with AMC. When they had 100 million shares, now they got 500 million shares, and each share is worth less because of the market cap of the company, right?
Yeah. The market cap of the company. I mean, they basically printed 400 million shares, like as if, as if a small country would have print $400 million. And right now investors are willing to pay up for that, but eventually, whether it's 6 months or a year or 5 years, that will come out of the AMC stock. And valuation has a history of being out of whack for periods, whether it's the .coms or if you the EV stocks and so forth. But eventually it does come back into reality, and it's just a matter of time. I think it's cool what the smaller investors are trying to do. I love the fact that people are participating in investing more, but I do hope that I hope that someone that buys it knows enough to at least take some profits off the table. If you're in at $10, you could just take your initial investment out. And then if you want to ride the rest for the next 5 years, that's awesome. But don't sacrifice your hard-earned money that you worked for, I would say.
Yeah, for sure, for sure. What are some ways that you hedge your positions? Like for me, like I'm always scared of the next market crash. So I'm buying these long term options on like SQQQ and some other stuff, and I'm like, hey, I'd rather risk this $200, per option, and protect myself rather than then become a victim of a market crash or something. Like, how do you hedge your positions? Because I don't look at the market daily. I mean, I look at like how my portfolio is doing, but I don't kind of read those trends or whatnot.
Yeah. So for what I do is I don't hedge directly. Like sometimes people will buy calls against a put, a short position, or puts against a long position. What I do is I'll have some longs in the market where I buy, like for instance, right now I do like Chinese stocks. Some of them are actually having a really nice day today. But I love the longer term prospect of the Shanghai Composite and the China economy, as economic conditions here get less lucrative for investors, meaning the Fed is eventually going to have to tighten because of inflation. Money is going to look for other places to go. I think China is a great place to be. So, stocks like Alibaba, Baidu, Tencent, those type of names are good longs. Overall, I'm short the equity markets, meaning I'm short the S&P, I'm short the NASDAQ up at these ranges, because I just think that you're due for a big correction based on all the technicals I'm seeing in the market. So I can show this cool chart here, and this will give everyone a basis for when the markets are going to really break down. So on this chart, this is a chart of the SPY, and it basically is a daily chart. And what you can see is I have two trend lines that are showing themselves. One connects back to the lows from March 2020. So that was the COVID panic lows. And what you see here is it basically kisses or connects through every low since then. And that's the line I'm following. So the market technically is safe as long as you don't see price trade below this line. If price trades below this line, I think you get a very sharp correction, as much as 10%. I'll show you where I expect it to go here. The 200 moving average is down around 375 to 380 on the SPY, which is currently trading at 422 and change. So I would expect as much as a 40 to 50 point drop, which would equate to about 10+% on the S&P, if this upsloping trend line breaks. So that'll give everyone at home kind of a good basis for what to look for if you're worried about being in the market when it starts to drop. I think you can stay in the market for now, but if that trend line breaks, then I would look to exit or get on the short side for sure.
Okay. That makes a lot of sense. So you have your support and your resistance, and when it breaks through that support line, then that means you may need to consider exiting that position because it could continue to drop.
Yes, and in fact, Bitcoin did that recently when it dropped from 50,000 to 20,000. Let me show you guys this chart because it's a very cool chart as well. Um, So here, let me remove my moving averages so we keep it as crisp and clean for everyone viewing. So you basically had Bitcoin making higher highs, so high, higher high, higher high, and higher high. And then you started to downtick here, and you can see this low is lower than this low. So that was a lower low. That was a change in character for Bitcoin. And then it rallied, and it was a lower high. So all of a sudden, you could see high and lower high, low, lower low, and that switched from this upsloping move. The next thing that was very concerning was a trend line that marked a head and shoulder neckline. I don't know if you're aware of what a head and shoulder is, but basically it's a pattern formation in the markets that's bearish when it breaks. And you can see shoulder, head, and shoulder. And here was your trend line, right? And then look at as soon as you got below that trend line here, in 3 days, you went from a 50,000 break all the way down to the 30,000 low here on Bitcoin. And that's what I would say in terms of the equity markets, the S&P. If that line breaks, it could be a very quick, fast flush to the downside. And you could really see a big drop. So definitely be aware of that trend line and watch, like you mentioned, it's support. If it breaks, watch out.
Yeah. So if Bitcoin breaks below 30,000, we definitely headed towards. Cause I heard your prediction of 20,000. So and I know Gareth is gonna come in buying up all the bitcoins at that point, huh?
Well, yeah. So one of the predictions, yes, yeah, so you're absolutely right. Eventually, I do think it's going towards 20,000. One of the things I've been saying ever since it made that low at 30,000 is that we could actually rise first close to 48 to 50,000, basically back to that support, that former support line. And for the viewers out there, support when it's broken now becomes resistance. So again, think of a door you just broke down. You just broke through that support level, that or resistance level, and now it gets built up the other way. It becomes strong in the other direction. So I do think you could see it in the short term, Bitcoin moving back up. My thesis for that is that the meme stocks are getting kind of overdone here, and I think you'll probably start to see money flow being pulled from the AMC's and the GameStops and rotating back into cryptocurrencies. And just going back to the meme stocks, another fascinating little tidbit is that when Bitcoin broke down here, that's when the meme stocks started to rip to the upside. And again, I think what you saw here is that the same investors that are in Dogecoin and Ether and Bitcoin, they're the same ones that are playing a lot of the meme stock momentum. And so money's rotating back and forth here, kind of like a pendulum. It swings one way and then it swings the other way. So if we do see the meme stock stall out and fall, my guess is Bitcoin has upside in the short term, but I still think you've got to flush people out to that 20,000 area before all is said and done.
Yeah, for sure. Yeah, I've actually been thinking about that. I was thinking, I was like, there's some type of rotation here with the meme stocks and then cryptos, and crypto's been getting kind of beat up. And so I've been, throwing money in there. I was like, I don't think it's over for the crypto bull market, So I expect that rotation to happen again.
Yeah. And I think you're dead on in that. And for a shorter term investment, I think a move up here in crypto is probably likely where you could see an easy 20 to 30% in the crypto markets before the next dip. Obviously go small because ultimately it is going down. You just never know when. But I do think that will happen. Absolutely.
Mm-hmm. Okay. So you mentioned the Shanghai Composite, and that was very intriguing to me because you did compare it to the Bitcoin chart before, and then and I've been investing in some Chinese stocks. I invest in JD, Neo. I mean, I felt like Neo kind of ran up way too fast. I mean, for it being an EV stock, but I feel like it still got potential. And then I'm also into the GOTU. And so you mentioned the Shanghai Composite. So that's kind of intriguing because like I've noticed like when market crashes, people do run to foreign equities, especially if it's like just a crash specifically in U.S. stocks.
Mm-hmm. Yeah, for sure. I mean, if the U.S. markets were to decline really quickly, heavily, then the Chinese stocks very likely would see a little bit of weakness. But I think they would hold up better because obviously it's not directly influenced by the U.S. economy. But yeah, I think that's the coolest thing in the world. I still remember discovering that chart. And if I bring up, for instance, here, I'll show my screen again here, and we can go through some of these charts. But just the fact that the Shanghai Composite chart looks identical. So if I show here, let me find this chart here. Here's Bitcoin's chart, and you can see here this is Bitcoin prior to the move where it went to 65,000. So this is how that chart looked prior to the 65,000 run where it broke out above 10,000 here and ran all the way up. And then if I bring up the Shanghai Composite chart, look at how it's almost identical in terms of its price action. And to me, that's something to kind of note. You wouldn't just rely on the identical charts to say, oh, well, this is going to go up, 3, 4, 500%. What you want to do is you want to look at the similarities of a Bitcoin versus the Shanghai. And for me, it's like, okay, well, Bitcoin's relatively new in terms of how long it's been around, since 2009, I think it was. And if you look at the Shanghai Composite, a lot of these stocks are relatively new as well. And it's an emerging market in terms of money flow. China still restricts a lot of investments in there. If you can kind of make a case where over the next decade, China may look to open things up a little bit. In fact, I just heard today that Biden canceled the banning of TikTok and some of these other things. So there seems to be a little bit of a warming of relations with China that also could be a benefit. And if you get any sort of kind of opening up of the Chinese economy, the Shanghai Composite stocks are just going to go to the moon.
Mm.
Yeah, so I think it's not something that I would say, okay, I'm in these stocks to pay off in 3 months or in 6 months, but they're investments that you could see the next $1 trillion company come out of a company right now that you're investing in.
Yeah, yeah, definitely. And it's also like looking at the macro picture of just like where China is economically as well. And seeing like, okay, I mean, there's already talk about them potentially being the next superpower country and all this stuff. So it's definitely a good argument for owning some of those equities.
And
Um,
remember, I mean, you look at like an Apple who has, the US market, and obviously they've expanded all over the world, but China has, 1.5 billion people. So in relation to the consuming public there, if they become a more of a consumer society, the upside on some of these names is massive if they become dominant in their industry.
yeah, for sure, for sure. Well, thank Garrett. Gareth, I want to thank you for coming on. How can my audience just connect with In the Money Stocks? Because I know you offer a lot of different services, especially with, education. I saw some educational courses. I'm going to link to that in the description. But what are some things you think would be good for the beginners that are getting into this?
If you're really new and you don't want to pay anything yet, go find me on Twitter at Gareth Soloway. I post usually a chart or two with technical setups and a few little key notes on there every single day. So that's at Gareth Soloway on Twitter. And then if you're interested, Verified Investing Alerts is my stock service where I do a daily video where I do a lot of technical analysis and teach a lot in them, go over trade setups and charts that we're taking, as well as give out trades that I'm taking as well. So that's probably the way to do it. You can just go to inthemoneystocks.com and you can see my name at the top of the website, and there's a drop down with my services underneath.
Okay, yeah, that sounds great. And are you mostly a share buyer or options trader? Are you both? Because I know some people don't really understand options, so I have to eventually do a video about that. But are
Yeah,
you?
and I appreciate that question because it's an important one. So 90% of the money I have that I invest with is for swing trading stocks. And the reason why I put most of it in there is because swing trading stocks, you're buying companies, they don't expire like options do. Once you get into the options market, you're basically adding multiple layers of complexity because an option will expire at some point in the future, depending on what your expiration date is. And so it's very hard. I mean, I do it and I have a service where I offer my trades, but I use a very limited amount of capital because of the risk. I mean, there's times where, my portfolio will have like 30-40% swings in the option side because, all my options that were long, these type of stocks are down, and it's just for newer investors, I would definitely recommend, like I said in the beginning, the slow, steady approach actually is a very fast approach if you do it correctly. And again, use that calculator and show yourself what compounding at 20 or 25% a year on even a 10,000 investment can be worth in 5 or 10 years. It's incredible, folks.
All right, sounds great. Thanks, Gareth, for coming on, and we appreciate you taking the time to do this.
Hey, thank you so much for having me. It was a lot of fun.
All right, thank you.